Hi, very good afternoon to all of you. Avinash, can we move to the next slide? If we look at US economy, US Fed is talking right and walking left. They have been facing one of the highest inflation since 1980. But despite facing this high inflation for some time, their balance sheet is not shrinking. If you look at the Fed balance sheet changes, it's barely noticeable, and hence Fed is talking about inflation, but except raising interest rates, they haven't taken much step on reducing liquidity. On the other hand, as interest rates have gone up, despite no reduction in apparent liquidity, the lead indicators are indicating sharp deceleration in economic activities in US. US first quarter GDP was minus 1.6%. Second quarter came at minus 0.9%. Now, because of the base effect and inflation relief, maybe the third and fourth quarter numbers will be positive, but there is always fear at US Fed if it continues to raise interest rates. Somewhere in 2023, third and fourth quarter, US again will slide into recession. As of today, market is expecting Fed to take Fed rate to 4 to 4 quarter by mid 2023, and thereafter there should be rate cuts which can begin in the second half of 2023. If the actual Fed rates are lower than 4 fourth quarter, there will be positive impact on market. But in case Fed decides to not cut interest rates in second half 2023, there will be some negative impact on market. On one side, American household has been damaged by high inflation. There are 20 million US homes, or 1 in every 6th household, which is late in payment of their electricity power bill. This shows that inflation has really hurt American household at the middle and bottom end. Despite slowing economy, corporate margins are at one of the highest level since 1950. In some sense, there are two America. Corporate America doing well despite rising interest rates. Consumer America, especially at bottom and middle end, doing quite bad because of the rising inflation. There has been sharp deceleration in equity flows over last couple of months. That's primarily driven by a diminishing outlook on global growth. If we look at global economy, world over, inflation shot US, UK, Euro area, but their interest rate hike has lagged significantly compared to inflation. Look at the gap between inflation versus interest rate hike. Clearly, developed world is way behind in managing inflation. On the other hand, within different countries, there is different approach to managing inflation. US Fed, ECB, Bank of England are raising interest rates despite being behind in managing inflation, whereas People's Bank of China is actually looking to cut interest rates to support growth. This is one nice cartoon showing the precarious position in Europe. They have been hit by one of the worst drought in recent times. And as Russia has stopped supplying gas, there is a strong likelihood that in the full winter, they will be left without power. The precarious position of Europe is also driven by their own limited investments in technology. For example, in Germany, which has just about 6 crore population, the German minister is asking about 18 months' time so that they can transfer money to German citizens. Today, they have capacity to do 1 lakh payment per day. In India, we do crores of payment thanks to our Jandhan, Aadhaar, and Mobile Trinity. In US and Western world, they still give physical vaccination certificate. We deliver vaccination certificate on WhatsApp. This lack of investment in technology in many Western world countries, including Europe, is creating serious limitation for them. In UK, supermarkets, instead of throwing expired goods, are throwing expiration date labels because they want to provide those expired goods to poor people. If we look at the recession chances in the world, UK has the highest recession chance of about 60%. In India's case, we have 0% probability of recession. This is a significant positive statement for India. The only silver lining among the dark cloud is reduction in commodity prices around the globe. Aluminium, zinc, copper, oil, wheat, soybean, all have corrected from their Russian crisis level. In that context, Indian economy is like oasis in the desert. No doubt there is a sandstorm blowing in global economy, and we will get impacted if this sandstorm persists. But as and when sandstorm subsides, Indian economy will look just like oasis in the desert. Why do we make such statement? Well, look at one crisis of 2008 to 2022. In that crisis, India is the only country who has improved its debt to GDP ratio. The corporate India has reduced their debt to GDP ratio by about 12%. Retail India has reduced its debts to GDP ratio by about 6%, whereas government, thanks to COVID, has increased its debt to GDP ratio by 11%. Overall, there is a reduction of 6% in India's debt to GDP ratio between 2008 to 2022. No other country has done that kind of improvement. This shows that India is truly an oasis in the desert. If we look at emerging markets tracker, consistently India is coming on top for many months. It's a matter of pride that we have moved from being 10th largest economy in 2014 to now 5th largest economy, having 3.5% market share in global GDP. McKinsey CEO was in India, and he said it's not India's decade alone, it is India's century. Such kind of statement does give confidence to global investors. In fact, if we look at top 10 cities with highest GDP growth in the world, in 2021, Bangalore and Delhi came into that league. In 2022, Hyderabad, Bangalore, Delhi, Mumbai, Chennai, and Kolkata all came into that league. Clearly, the fastest growing cities are now in India rather than rest of world. If you look at Amul's annual report, currently their turnover is 61,000 crore and they are India's largest food company. By 2047, in our centenary year, their aim is to achieve turnover of 18 lakh crore. That's about 30 times from current level, and they want to be world's largest food company. This is the fascinating story of Amul, from being India's largest food company to being world's largest food company. That's what is changing India compared to US, where 1 in 6 household is late on payment of power bill, or Germany, which needs 18 months to transfer money from their bank account to citizens' bank account, or UK, where instead of throwing expired goods, they are throwing expiration labels so that poor can be fed. If we look at the news headline about India, from 75 lakhs iPhones in 2021, we'll be making 1.2 crore iPhones this year. The manufacturing PMI index at 56.4 is highest in the world. EPFO is now adding over 1 million new customers every month. The Fastex collection is at all-time high level. The retail inflation is above RBI's comfort level, but it is moderating. The only risk, the red flag for India, is the trade deficit, which is running at $30 billion a month. If you look at capacity utilization, now it is above pre-COVID level of more than 74%. If we look at economic activities consistently over last few months, it's growing, and we are now at all-time high level of economic activities. GST collection for last almost 6 months is more than 1,40,000 crore, showing economy is doing well. Because tax collections are strong, government's receipts are at record high. Expenditure also has followed income, and despite that, today deficit is at a lower level. %20 of government is now capex. That's a significant improvement compared to what we had in 2010, 11, 12, and 13. If you look at cities where construction offices are being constructed, cities like Hyderabad, Bangalore, Delhi are having far more construction compared to the rest of the world. The only weak spot in our economy was consumption. In December 22 quarter, consumption volumes were down 2.6%. March 22, it extended to minus 4.1%. And in the month of June, in the quarter of June, the FMCG volume declined, but by only minus 0.7%. Now for September quarter, it seems that consumption pattern will become positive. It will be probably in low single digit from a positive growth point of view. If we look at survey of some of the larger malls, now the sales in these malls is roughly about 122% of their previous year. This gives confidence that hopefully in the month of July, the FMCG sales will turn positive. Banks are extending credit as borrowers are forthcoming. Now, credit growth is 15.3% on a year-on-year basis. More importantly, companies which are borrowing this money are fairly solid in terms of their balance sheet. The combined debt equity ratio for corporate India is consistently improving. Even banks which are lending money are seeing rapid decline in non-performing assets. Most NPAs are well provided for. So we can see that not only corporate India, but even financial services India is in a better position. PSBs have also focused on recovery, and they have recovered about 6,42,000 crore from the loans which they had written off during that period. IBC has started helping banks recover dues, and banks are today generating far better recovery compared to the past. Monsoon compared to our long-term historical average is 8% positive. The reservoir level compared to 10-year average is 25% higher. And it looks like we will end the monsoon season in October at record reservoir level. The red flag in Indian economy continues to be our trade deficit that's running at $30 billion a month. And while rupee has depreciated against dollar, against yen, it is up 19%. Against euro, it is up 11%. And against GBP, it is up 6% from Jan 2021. Imagine Japanese exporter or European exporter, what kind of advantage they will have with this kind of massive currency appreciation. Oil prices, the good news has continued. This number, as I look on the screen today, is below 90. And as oil continues to come down, it's beneficial for Indian economy. On oil, apart from demand-supply gap, geopolitical factors make an impact. Citibank made a prediction of oil at 65 if everything goes right, and JP Morgan made a prediction of oil at 380 if everything goes wrong. Let's hope and pray that oil moves towards $65 rather than $380. The other interesting thing which India will have to keep in mind while formulating its policy, there are many people who will be happy to mislead us, who will be happy to waylay us. Today, we are one of the lowest country in terms of carbon emission on a per capita basis. Countries like US, countries like Canada are way ahead of us. And despite that, there is tremendous pressure on India to become carbon neutral. And they push us by giving this kind of report that by 2050, net zero target on carbon emission can boost India's GDP by 7.3% till 2032. The same people, when they have to advise developed world, they say net zero emission policy will bankrupt Britain, so please don't follow it. We are the guinea pigs on which all experimentations happen. We'll have to believe in the adage, suniye sabki, kariye apni. Listen to all, but do what you think is appropriate. In that context, if we look at equity markets, it's always difficult to predict equity market. In June 2022, Bank of America predicted Nifty target at 14,500 1 year forward. And when markets bounced back in August 2022, they said Nifty should be somewhere between 17,000 to 19,500 range by year end. Clearly, one is a bear market estimate, other is a bull market estimate. And a solid research company like Bank of America failed to predict where the markets will move. India has done massive outperformance over MSCI emerging market index compared to our peer group. We have delivered fantastic return. Since 2014, we have delivered double the return of China. We have delivered almost 20 times more return than Brazil. And we have delivered positive return to South Africa, whereas South Africa is negative. Even if we take entire emerging market against their 2% US dollar return, we have delivered 9% US dollar return, almost 4 times higher. If we look at India's weightage in MSCI emerging market index, at one point of time, China was almost having more than 4 times weight compared to us. Today, we have grown from 7-8% to 14%, and China has come down from 36% to 29%. Now, the gap between China and India's valuation is just about 2 times compared to 4 times before. We trade at a significant premium to other emerging markets. When you look at MSCI India PE ratio of 25 versus MSCI emerging market PE of 21, we look like as if trading at 100% premium. But if we remove from MSCI Russia, then the premium comes down to about 76%. It is lower than 100% premium, but it is certainly higher than our historical average premium of about 55-60%. More importantly, for foreigners, cost of exiting India has been very high. They sold $32 billion between October 21 to June 2022, and they brought markets down by 21%. Now they have turned buyers from 15,200 Nifty. Nifty is at about 17,700, and it's up about 14%. And the total stocks bought by FPI during this period is just about $8 billion. When you sold $32 billion, you fell down 21%. When you are buying 8 billion, you are going up only by 14%. That's the self-reliance which India has got thanks to domestic investors and thanks to distributors like yourself. If we look at past, whenever foreigners used to sell, our markets used to correct 30%, 60%, 40%, and so on and so forth. This time, when foreigners sold, please go back to previous slide. This time when foreigners sold far more than what they have sold in previous such period, markets has barely come down by 4%. This is all possible thanks to the domestic investors' support to mutual fund industry. You gave us a lot of money to buy from FPIs, and now we are recognizing that as they realized we have sold more, we will not, as they've realized that we have sold India far more, they are coming back to buy. Now, in emerging market, FPI buying is beginning to be seen. India will also benefit out of this. Current weightage of India in MSCI is about 14.1%. We believe if we can work with MSCI to upgrade Korea from emerging market to developed market, or ensure that HDFC Bank gets included in MSCI Emerging Market Index, then our weight in MSCI can go further higher from 14.1%. And that increase in weight will result into better flows from investors, from global investors in the days to come. Next slide, please. If we look at equity valuation, we are at a marginal premium to our historical average. Historic P is about 18.5 times. We are at 19.6 times. Average PB is 2.7. We are now at about 3 times. The quarterly results which came for June 22 quarter, 20 companies delivered results which resulted into upgrade, and for 24 companies, there was some amount of cut in the estimates. Against expectation of about 31% earnings growth, the actual profit growth came roughly at about 23%. It's disappointing in some sense, but the breadth of the earning has been fairly good. The disappointment in earning is driven by public sector oil companies, public sector banks, but rest of the small and mid caps have actually delivered results ahead of expectations. One sector which saw erosion in margin, that's IT companies. Compared to second quarter 2020, in first quarter FY23, their margins have actually come down despite rupee appreciating. The domestics are buying because they are seeing improvement in corporate profitability. Corporate profit as a percentage of GDP has almost doubled in last 2 years from 2.2% to 4.3%. If we look at longer term cycle, the market cap of the company moves in line with their profit pool. As profits have kept on increasing, market cap has kept on following. Obviously, there were periods where, due to global crisis, market cap was lower than the profit pool. There were periods like 2004 onwards, 2020 onwards, where profit pool was below market cap rise. Now, as you see, the gap is fairly narrow between profit and market cap, and it shows that market is probably fairly priced around this level. If you look at auto sector, their contribution in top 1,000 profitable company ranges between 1% to 11%. The current corporate profitability of auto sector is about 2.5%. We think auto companies' profitability share will go from 2.5 to about 11%, and that will make investment in auto rewarding. Through same logic, we have industrials, we have cement, and we have consumer discretionary, where profit pool is lower than their market cap. At this point of time, keeping in mind the uncertainty, we believe this is time to have neutral weight to equity. Large cap, one can be marginally overweight, and small and mid cap, one can be marginally underweight. The best time to buy market is during correction, and this market is no different. It is buy on dip market and डर के आगे ही जीत है. From an investment point of view, this is a very interesting slide. If you look at between 2009 to 2021, for which this data is available, companies in which domestic mutual fund had higher stake, they have delivered the best return. Companies where FPIs have higher stake, they have actually underperformed mutual funds. Companies where retails have a higher stake, they have also underperformed mutual fund. And companies which are mainly driven by promoters, even they have underperformed mutual fund. Clearly, mutual fund managers know how to pick up the stocks. Our fund continued to generate alpha across most of the categories. Kotak Flexi Cap is one fund where over the last 3 and 5 years, alpha generation is not satisfactory. But I'm happy to state that in last 6 months to 1 year, fund has bounced back quite nicely. Hybrid funds like Balance Advantage Fund, Balanced Fund, or Asset Allocator all have delivered positive alpha over their history. If we look at systematic investment plan, the returns over 3, 5, 7 years are all in double digit. And alpha is as high as 17% on a 3-year basis for small cap fund. Again here, Kotak Flexi Cap fund performance is not satisfactory. Here, investors haven't made alpha, but I'm sure if they remain invested, that opportunity will come. If we look at SIP in our hybrid funds, the alpha is mid-single digit to low single digit. One of our fund, Kotak Pioneer Fund, has local as well as global exposure. Global exposure is about 19%. Local exposure is about 81%. This fund is investing into innovative companies in local market as well as global market. And since inception, almost about 3 years back, this fund has delivered close to 25% compounded return. About 17,000 crore worth of flows came in local plus global fund. And clearly, Kotak Pioneer Fund is something which you can take to your customers as it has outperformed most of the peers. We had launched Manufacture in India Fund in February 2022. That fund has also generated 5% alpha as manufacturing theme has taken off well. Manufacturing will do well thanks to PLI scheme, thanks to private capex, thanks to mergers and acquisition consolidating supply side, thanks to private equity and venture capital investment, and most importantly, China plus one, where all global outsourcing supply chains are moving out of China to other countries. Kotak Multi-Cap Fund, which we had launched in September 21, that also now is at its all-time high NAV, and the allocation of global Kotak Multi-Cap Fund is biased towards large cap, as we have recommended marginal overweight large cap and marginal underweight small and mid cap. One fund where investor experience has not been positive is Kotak Global Innovation Fund of Fund. The NAV is down 30% from the face value. This has been a series of events which is beyond our expectation. Immediately after our investment fund corrected about 10% because of China tech sell-off. Thereafter, Nasdaq got impacted with rising US interest rates. And finally, when the money valuations become very attractive to invest, the RBI put a ban on taking foreign money offshore. Global Innovation Fund clearly has not delivered as per the investors' expectation. We believe this fund is still worth holding for a longer period of time, and it has all the characteristics or portfolio holding of bouncing back. Coming to the hare and tortoise story, many investors have asked Nilesh bhai, aisa fund dijiye which goes like rabbit on the way up and comes down like tortoise on the way down. There are 3 funds in our category: Kotak Equity Savings, Kotak Multi-Asset Allocator, and Kotak Balance Advantage Fund. In Multi-Asset Allocator, we put about 5 to 95% of money in equity funds. Over last 18 odd years, we have invested 46% average equity. On that 46% average equity, I have delivered 65% participation when markets are going up. And when markets fall, I have only delivered 29% participation. My upside to downside ratio is more than 2. And currently in asset allocator fund, we have total exposure to equity of about 71%. This fund over last 18 years have delivered consistent return where on the way up it participates higher, on the way down it participates lower. These are the funds which are ideally suitable for senior citizens, conservative investors who are worried about market volatility. If we look at NFOs, what we launched on India dedicated side, like multi-cap or manufactured in India, returns have been fairly impressive. Whereas funds which we launched for the offshore market, like Global Innovation or like Nasdaq 100 Fund of Fund, both have delivered negative return to investors. From yesterday, we have launched NFO of our Kotak Business Cycle Fund. It's an unrestricted, unconstrained fund. Pankaj Tibrewal, my colleague who is managing emerging equity and Kotak Small Cap Fund, is going to be manager of Business Cycle Fund. This fund will allow Pankaj to invest in any sector of his choice as recommended by our investment team. And he can invest across any market capitalization, be it large, mid, or small. Clearly, this is one fund. We need your participation and support. This is suitable for your investors in a market like today. Unrestricted sector exposure, unconstrained number of stocks. Put together, this is a fund which should get part in your client's portfolio. Next slide, please. Coming to the crypto or other assets, I got an interesting chart which showed how metaverse asset prices have corrected significantly. Despite having the Facebook parentage, the prices in metaverse or the virtual world promoted by Facebook has seen sharp correction in the prices. Next slide, please. Compared to rest of the world, India was ahead in raising interest rates, and it has also raised interest rates sufficiently faster to cool down inflation. We are one of that rare country where inflation is still around mid-single digit. If we look at global bond markets, they have corrected about 20% from 2021 peak. Not only in equity, but also in bonds, people have lost money. Our inflation continues to remain below American inflation for now almost a year. This had never happened in the past, but now it is happening. Compared to rest of the world, by raising interest rates sufficiently and timely, RBI has done a wonderful job. And today, compared to the rest of the world, we are in far better position. RBI, seeing good monsoon, has now kept their inflation target at about 6.7% for the whole of FY23 and about 5% towards the end of the year. RBI was ahead in controlling liquidity, and so far through judicious mix of 14-day repo and other measures, liquidity has been contained reasonably well. At this point of time, yield curve between 3 to 7 year looks attractive from an investment point of view. One big positive which can happen to India is inclusion in JP Morgan bond index. This time, investors are telling JP Morgan that in your bond index, please include India. Russia, they can't invest. Brazil, South Africa, again have their own challenges. India is one country where there could be large amount of issuances, and hence now investors are behind JP Morgan to include Indian debt in their index. In the debt investment side, we have always recommended that if you are having 3 months to 1 year horizon, keep your investments in funds like money market fund, savings fund, and low duration fund. If your funds are invested in a longer tenure, like 9 months to a year, 1 to 2 year, 1 to 3 year, in that kind of scenario, Kotak corporate bond fund, Kotak floating rate fund, Kotak bond short term, or Kotak banking fund will be more suitable. For a longer term, undoubtedly one has to take longer term horizon, and their dynamic bond fund or Kotak bond fund will be more suitable. There is trend of investing in roll down strategy. We believe active fund manager will still be able to deliver better return than a roll down strategy. And here you can see how 3-year government securities on a steady state basis, on a roll down basis, have not been able to deliver return comparable to an active fund. Kotak Dynamic Bond Fund is a fund where fund managers continue to take interest rate call, duration call, and they have delivered fairly good performance over last 4-5 years. For investors who are getting hit by lower interest rates on debt and bank fixed deposits, they can consider investing in hybrid funds. As I mentioned, Kotak Equity Savings Fund is a fund which goes faster on the way up and falls lesser on the way down. And you could see that it has consistently delivered low double digit to high single digit return. The same thing is true for Kotak Debt Hybrid Fund or Kotak Equity Savings Hybrid Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.